What's going on, guys? It's me, Prince, back with another video. So today's video is going to be a short one, but very important. I'm going to show you how to risk less while making more, right? Which is like a perfect combination. Now, the way we're going to be doing this is that we're going to be looking at some structure levels, because not all structure is created equally. I've reduced my losing trades significantly just by making this tweak. Okay, so it's gonna be a short one, guys. If you like the video, like it, subscribe if you're new. Give me some comments if you got any questions. And again, we still have some slots open. Some slots just opened up for a one-to-one consult with you and I, where I get to look at your trading and tell you exactly what is, what kind of stuff you're doing wrong, and if I'm able to help you. And you get to ask me questions as well, and hopefully we get to clarify what you're struggling with by the end of the call. So I've got all those links in the description. I've got my Instagram in there as well if you want to click on it and check me out on Instagram. And guys, let's jump into it. Hello traders, welcome back to the battlefield. Today's video we're going to be talking about market structure and how to differentiate between worthy and unworthy market structure. So I'm just going to quickly draw out what a market structure looks like. So normally, typically you have an initial move, then you have a retracement, then you have another move, then you have a retracement. But sometimes you have a clear break, a retracement, and then sometimes you have a mini break and a retracement, and the market just carries on. Technically, these two breaks are new structure highs. So you have an initial structure high, you have a new structure high, you have a new structure high, you have a new structure high, and you have a new structure high. Now, these are all equally new structure highs, but you shouldn't be looking at all of them to take a trade with. Now, I'm going to explain to you why. So let's look at one of the examples on a real chart. So looking at Aussie CAD, we can see a clear bullish trend. I'm just going to draw this out so it pops out to you, right? So we see a clear bullish trend happening, right? And technically, if we are structure-based traders, we are looking to take the trade at the retest of structure. So we are looking to take trades when we retest the previous structure high. That means when market comes back to retest the previous structure, we take a trade. Now, we also have other things to consider. We also have to consider risk management, and we also have to consider previous levels, other levels of structure as well, depending on what kind of trader you are. Now, let's say, for instance, if you are a trend continuation trader and you're looking to get into this trade. Let me just clean off this chart so it doesn't get too messy. Okay, so let's say you're waiting for the breakout. We have a breakout here, a clean breakout. We have a retest, right? That's an excellent place to get in if it meets your rules, right? You have your stop and you have your target. That would have been a very clean trade. You would have won. But then we have another breakout here and we have another retest here. So following your rules, you would have had your stop below the level of structure where you got in, which is right there. You would have had your target at the next level of structure, which is right there. And obviously you have your entry, which is the retest of the structure level. Now, if you're going by those rules, you are going to very quickly run into trouble. Now, let me show you why you would have run into trouble at the next example, actually. Because we have a very basic way of trading, we are saying that as soon as we have a breakout and we have a retest, we should get in. Well, technically, going by that logic, as soon as we had a breakout here as well, we should be getting in at the retest of this structure level. This is where we would have gotten in. Now you can see these two structure levels here are not created equally. They are both breakouts, but you can see very clearly why you should not be paying more attention to this one, because if I would have taken this trade right here, I would have won, but I would have been risking essentially so much money. I would have been risking, what is this, like a 10 to 1 risk risk to reward. I'm risking 10 times what I'm looking to make on this trade. So that is not a good thing. Now, this is why you need to wait for something I call a deep break. What that means is when the market breaks, you need to wait for a very pronounced break, more like a U curve. The market needs to break out properly. This market break here was not convincing at all. I mean, in this example, it did go on to make new structure highs, but I wouldn't trust this here. I don't know what exactly is going on here, because the market fakes you out a lot of the time. You have people who get into trades and then a huge candle just comes back down, spikes down and takes you out, or spikes up and takes out your stop loss. This could have easily been what is happening here. This could have easily been the bulls pushing the market, giving it one last push before it went the other way. When I'm looking to get into a trade, I'm looking to get a very clean break. And that is exactly what we got here. If you look at the next example, right? Let me just grab my tool here. If you look at the next break that we have here, you have technically have another one here. And then you have this huge break. Now, this is a lot more convincing. I'm a lot more comfortable with this. And then obviously we had the retracement as well. Now, I showed you the first example where you had a 10 to 1 inverse risk to reward, which was ridiculous. But in this example, right, this is the area where I was looking to get in. And you can see, if I use a conservative way of getting in, obviously I would have used a double bottom. But two things happened. I would have had a more conservative way of getting in, so I would have had exactly where the price where I would have gotten in, because I have a double bottom right there. You can see it right there. You have a double bottom. And secondly, I have a higher risk to reward, as opposed to the first one where I could only make like 1 pip to 10. I'm risking 10 pips to make 1. In this case, because we have a huge zone, but we didn't really get an entry reason until we got all the way down here. Now, this is good for me, because the lower we get, the more chances of me making more if I do take the trade. So what ends up happening is I get an entry here and my stop is just right beneath it. I'm not risking that much at all, but I'm making so much more, as opposed to this example here where I was only making about a 1/10 of what I was risking. So anyways, guys, if you like that video, give it a like, subscribe, share, with someone who you think is going to get value from this. And of course, if you've got any questions, put it in the comment section below and I will get to it. And if you would like a one-on-one consultation with me, right, you're struggling with your trade now, and if you've got any questions at all, I'm going to put a link in the description as well where you can book a one-on-one call and speak to me personally. And yeah, guys, I will see you in the next one.